We are delighted. This is the second in our series of online events for the summer program for GAIN. GAIN, Girls Are Investors, for those of you who don't know, is a community with charitable status set up to change the status quo in investing. And in particular, we want to inspire and inform the next generation of decision makers. And in particular, we want to encourage more women to apply to the industry. And we want to tell you about how brilliant a lot of the career opportunities are, which is why we have such a fantastic panel here this evening. I'll come on to our panelists in a moment when we have our third member hopefully on the line as well. But just to kind of give you a bit of a flavour of what we're aiming to do this evening. So we've got around an hour. We are very lucky at GAIN. We've got a network of over 100 women who work in investing and in all sorts of parts of investing. So this is the most important thing really to take away. Here we got no, I've got another version of me just come onto the screen. We've oh, it might be Sophie under a login. But the best thing about investing, in my mind, is that there's so many ways to skin the cat. So you really can bring your skills to bear on the industry and do it in the way that you want to. And one particular part of investing that we're going to be covering this evening is fixed income. So we really want to bust some of the jargon that surrounds what is potentially quite impenetrable from the outside, and just really explain to you what is the day-to-day job of being a fixed income investor, and also what all the different options out there are, because there are lots of different ways to do it, and we're lucky to have such a wide-ranging set of experiences on the panel. So very pleased to have you all here for that. Just to give you a heads up on the format, so I'll moderate. For those of you who haven't listened to our previous panel discussions and haven't been bored by my voice before, I'm Charlotte Yonge, and I'm one of the co-founders of GAIN. I'm also a fund manager. I'm a fund manager at Troy Asset Management, where I run the Trojan Ethical Fund, and we're going to be talking a bit about responsible investing as well tonight. So three main sections to this evening. The first is going to be just introducing our wonderful panelists and talking a bit about their career paths. Hopefully giving you some insight into the very many different backgrounds that can then provide a background for a career in investing. Secondly, kind of drilling into fixed income, what it is, what kind of skills you need to be good at it, what the industry looks like. And then finally, we want to give you some tips and advice. So really focusing on what you can practically do to optimize your chances of a successful career in this industry. And I would stress all the way through, we want this to be as interactive as possible. Please do use the chat function, so the webinar chat function. You can send in your questions and we will try and answer all of them. And if not, we'll be able to type you responses. So please keep interactive on that. And without further ado, we'll hopefully be joined by our third panelist in due course, but we'll move on to just letting each of the panelists introduce themselves, starting with you, if that's okay, Christina. So I should mention, we wouldn't be the charity that we are today without our wonderful sponsors, of which Christina's company, Musinich, is one. And just to be great to hear, Christina, what you do currently at Musinich, and also who you do it for, who your clients are.
Excellent. Great fun to be on this panel, and thank you so much. So Musinich is a credit investment house. So all we do is credit. And within that, I've been there for 7 years, and I run Asia credit funds. So what we do is we invest in Asian companies that will issue bonds, and bonds is a form of borrowing. So we're kind of effectively like lending them money. And fixed income is called fixed income simply because, you know, you're supposed to be getting a regular cash flow, a regular coupon, the interest rate on that bond. So it's a form of lending. So the big difference between fixed income and equities is that, you know, with equities, you'd have a share in the company and take part in the growth or the losses. But with fixed income, you expect to get the money back, and you're lending to them, and so for a fixed term, and so it's a different kind of philosophy. So there, I do the Asia stuff, and I don't know, is that enough? Or a bit my background? I'm I've had several different positions within the investment and finance industry. I worked as a rating agency analyst. Ratings are kind of, quality assurance kind of grades for companies. The best companies are given a AAA, and the worst companies are given like junk status, like single B or even triple C. It goes all the way down. So I did that. Then I went and became, an analyst for a bank to recommend fixed income investments. Oh, why don't you buy this? Because it's really attractive, and write the reasons why. Then I moved to actually doing the investing. So go to what's called the buy side. So where I was buying these bonds, but as an analyst, I was doing all the work. So I was an analyst. And then I became a trader. And then from a trader, I thought, I don't want trading. Trading is different from investing. It's too short term. The clock resets to 0 every second, and it's just too short term. I want something a bit more intelligent, a bit more long term. And then I moved to investment. And now I've been at Musenich for all this time. A very long answer.
Brilliant. No, that's fascinating. Thank you. And it would be great to come on to lots of your experiences in a little bit. Sophie, welcome. We're delighted that our technical barriers that we've set up to this call were surmountable. Thank you.
Thank you. Sorry for being late.
Not at all. So we're just doing intros. So maybe come on to Eusta, just a little bit about what you do. So Eusta's at PIMCO, and it'd be great to hear about what your job is, what you invest in, what types of assets you invest in, and who you do it for, who your clients are.
Yeah, so I think Sophie will be able to touch on more on who our clients are at PIMCO, but it's traditionally we are dealing with institutional investors only, and typically they have a very long-term horizon when they put their money with us. It could be for private bank portfolios, and it could also be pension funds, could be university endowments. But coming back to my own path, I studied economics at LSE almost 10 years ago. I graduated 10 years ago, and after graduation, I joined Goldman as a credit trader. So I was focused on European banks and financial institutions from then on. And after running my risk for 8 years at Goldman, I joined PIMCO as a portfolio manager in financials again. So here we look at the whole range of the capital structure, which you don't have to worry too much about. It's just different forms of debt, as Christina outlined earlier. It's different forms of lending. So we essentially assess the riskiness of the investments that we're making and determine a fair rate of return that we should be expecting from these investments, and adjust our portfolios accordingly. So to macro factors or to company-specific factors, and that's pretty much it.
Thank you very much. And we'll come into your career path as well. That's really interesting. Thank you. So Sophie, you're also at PIMCO. Could you describe a little bit about your job? Because we're really lucky today that we have multi-faceted panel that can show us not only the sort of decision-making or portfolio manager roles within fixed income, but you do a more client-facing role. If you could describe what you do, that'd be great.
Yeah, well, so different to Eusta and you both, I don't make the investment decision, or I don't decide where the money is invested for the clients. So my role is client facing. I speak to pension fund clients every day. At the moment, I've been covering UK pension fund clients for a couple of years now. I used to cover French and Dutch pension fund clients. So what does that mean? So if you think about any big UK name or any and most of the companies that you'll be familiar with, they would have a pension fund. And what we do is that I speak to them every day to make sure that PIMCO is investing the money in the way that they would want to, as well as coming up with solutions for them. So if they're looking to achieve higher return targets, or if they want to de-risk, or if they have a problem, or even say at the moment the oil price is very low and they have a question on whether they should be investing in countries that are oil importers and oil exporters. So it's really very different from investment related to their scheme objectives. But the goal is to help clients make an investment decision, but also the goal is to make sure they achieve their long-term objectives. So every client would have risk constraints as well as performance objectives. But in addition to performance, they also might have other objectives such as ESG, which is environmental, governance, and social concerns. They might have objectives to make sure that the company that we invest in is in line with their values. So my goal is to make sure that our clients are happy and that we are investing according to their objectives.
Great. And interested, you mentioned, Christina, your career path into this. Can you just give us a little bit of a background as to what you studied at university, and then how you found out about credit and what attracted you to that part of investing?
So actually, I had an arts degree. I wanted to study languages, literature, and I went to university in the UK, and I studied Oriental Studies, which is a mixture of languages and all of it. I actually thought I would end up in a museum as a curator. That was one of my dream job. I actually fell into finance because at the time, what was I didn't really know what finance meant and investment, or what a job in a bank meant. But I knew what I was passionate about, and I was passionate about speaking different languages, meeting different people from different countries, traveling, and I thought that maybe finance would be the place where I could do that, and that was about as much as I knew about it. And my first job was actually with a Japanese bank, because I spoke Japanese, and then from then on I just fell into all these different jobs. So I think finding out what one is passionate about first, and it might not equate to, oh, this will be the career, but if you just think about what you enjoy doing, and then things will lead you in that direction.
Brilliant. And Sophie, I know you also, for your degree, had a sort of languages or an art bent to your studies. Is that right?
Yeah, I studied business and Chinese studies because I wasn't 100% sure what I wanted to do as well. I thought that maybe I would do something related to either translation or working for a company in China. And I also wanted to learn about economics, but also focus on the Asian region, and kind of fell into finance when I moved to London. But the great thing about not having just a finance degree, or not just having a specific focus then, is that I think you have broader horizons as well. You have more options to go into after university. And most companies like PIMCO and other financial companies, they don't just look for people with science or math or economics degree, even though there are a lot of people with those degrees, but there are also a lot of people with arts and languages. And my ex-boss had an art history degree at university, so it's really not just for people who've done degrees related to finance that go into finance.
Yeah, I think that's really important. And Eusta, I know you studied economics, but I think this point that you made, Christina, as well, about not necessarily knowing exactly what you want to do. Eusta, I know you work for the sell side, and I think it would be really helpful for everyone dialed in if you could kind of explain what you did on the sell side. What is the sell side? And kind of unpack that in a really succinct 10 seconds.
Yeah, I'll try my very best.
Yeah, what drew you to the buy side as well? Thank you.
Okay, sure. So I would start from when I was still at university. I ended up coming into finance via internships, and that was because I was hanging out at company recruitment events with my friends. I didn't know that's where I wanted to end up. So you ended up going to events, and then you ended up doing the internship. And during the internship, I found out what sell-side finance was about. At the time, it was very exciting. It was the attraction for me was you work with the smartest and the best people, the fastest in any given field. It almost doesn't matter what it was, but you get intellectual stimulation, you get the exposure to people who want to be the best in whatever they do. And for me, that was enough. And in terms of the day-to-day, it's a little bit more grueling. So I did internship at Goldman, and that's where we were exposed to different sides of sell side. So you have sales function, you have trading function, you have research and strategy functions to choose from. I ended up getting offers only from trading desks for whatever reason. And in the end, I feel like that's also what suited me, because you essentially, trading on sell side is providing a price on risk. And this risk is most of the time liquidity risk more than anything else, because on the sell side, you provide prices for your clients, your buy-side clients, which is your PIMCO and your Muzinich, your BlackRock, etc., to transact on. So when they want to do a transaction, they come to you and they say, where can I buy and sell? And as a sell-side trader, you're a market maker, so you make that market. So you have to understand where assets are clearing, but most importantly, you are the middleman connecting the buyer and the seller. So that's, for me, that's the biggest differentiation between sell-side trading and buy-side investing. After that, I think doing it for 8 years where you run your own risk book and you build up your own client network, you build up your own understanding of the financial services industry, you think, hang on a second, I feel a lot more fulfilled, or I would appreciate the time and the space to think about investment. I want to be able to sit down, review a piece of news, think about how this will have an impact on asset prices, how I can put my skills to use, for instance, for someone's investment or for someone's pension, etc., etc. So that's the motivation behind the move from a sell-side function, which is more, as Christina put earlier, very short-term focused, short-term oriented, and liquidity focused, I would say, to a longer-term value-driven investment decision process.
That's great. So yeah, you're providing something for your clients, and you've got a more sort of long-term strategic view with which to do that. And Christina, I know that you previously have worked in various different spaces within fixed income. Could you kind of explain to us what led you to ultimately want to be a fund manager, and what the other roles were that you had previously?
I think one is that the job of thinking more long-term and creating value is what really motivates me. And the second thing is that it's not called financial services industry for nothing. You are actually providing a service. And there are various services that you can offer, just Eusta's just mentioning about providing liquidity. You're providing a service to your clients who want to transact, buy and sell different securities. That's one kind of service. But the kind of service I wanted to provide was kind of building on a relationship with the investor long term, and provide a good service. So what I thought what my main job was to, and what I think every day, is how can I provide value for my investors? You know, what is their goal? We heard from Sophie earlier how every client has a different goal and different investment target and objective. And I have that in mind every day. And when I wake up every day, what motivates me is like, I've got to make this return for my client. And I actually almost know every client that's in my fund. And that's maybe a bit overkill, but I really want to know who's investing, and I meet the investors. And at the same time, I've met every company that I run a fixed income fund. You have more companies in a portfolio, typically 100 or 150 even. And I've actually met all these 100 companies, and I meet them regularly. And although I'm not the analyst, I really care about that. So again, what inspired me is the service long term. So I digressed, which I always do.
Yeah, no, that's fantastic. And that is a great segue on sort of the second section that I want to cover, which is kind of the day-to-day, what you end up spending your time doing. And maybe starting with you, Sophie, if that's okay. If you could just sort of describe, and sometimes this is hard because such varied jobs, but a day in the life of Sophie, and does your job entail travel? When you're meeting with clients, how are you interacting? Are you on phone calls? Are you going to see them? It'd be great to hear about your day to day.
Well, I guess pre-COVID, there was a lot more traveling, and I've been really impressed by how the industry and everyone has been able to adapt so quickly into working from home and doing meetings from home. But I guess if I focus on pre-COVID, so most of my clients are based in the UK. A couple of years ago, I did work with clients in Switzerland and in Benelux, but the last few years I wanted to focus on UK clients. So day to day, if I didn't, depending on my meetings with clients, I'll start the day with reading the markets, and there are regular things that I know I need to do, and there are things that come in from clients that I haven't expected. So for example, I might have a client who's thinking of changing the investment strategy. I'll be speaking to them in the morning to understand, what kind of opportunities they're seeking. Maybe currently the investment environment is very suited for investment grade credit, for example. A couple months ago, the valuations were very attractive. And some of my pension fund clients might be thinking of going from equity to fixed income, increasing the fixed income exposure and decreasing their equity exposure. So we could propose doing an analytical study for the client to see what kind of return expectation that would give them long term based on the investment horizon. And then the day mostly consists of speaking to different clients as well as analysis. So for example, currently I have a client who is interested in going into a more low risk strategy from our investment grade credit strategy. So we're currently doing some analysis on what that would look like if they were to do that. And then sometimes, depending on the meetings, I could have a trustee meeting where myself or portfolio manager or together we would talk about the investment strategy of the client, how they've performed over COVID, how they've performed like this month, and then tell them our outlook. As a firm, we are very focused on making sure clients are clear and understand our views. I think integrity as well as trust and honesty is very important. You need to be very upfront and honest with your client if you have lost money, but you also need to be very honest in the how and work very hard to make sure you are going to get back the money, get back the returns. And it's really based on a mutual respect and mutual trust and honesty. There are times we might not always get our trades right. We hope that most of the time we'll get the trades right, but most of our clients have been with us for many, many, many years. And they are not clients that would just leave because we may underperform for 1 month or 2 months. So I think that trust and honesty and respect is so important, in addition to educating the clients and making sure we are achieving the investment objective and above. And I would say, that's a simple way to summarize the day, but it really is very varied depending on the market situation, the environment, and what clients want from us. So no day is boring, and every day is a learning opportunity for me. And I still find it's so important to be learning every day. And I think that in any job, if you come to a point where you don't feel like you're learning anymore, that's when you should go to another role or go to another firm.
I think that's spot on. And one of the best things about this job, I'd be really interested in your day-to-day, particularly how you approach research. Christina mentioned meeting with companies. I'd be just fascinated to hear about the process that you do, the due diligence, and also how responsible investing comes into that. So if you mentioned ESG, I think that's really important on the whole trust point of this industry and doing something that's socially impactful as well.
Of course. So I would talk about it. I would think about it in this way. So whenever we assess an investment opportunity, for instance, the due diligence comes into play. And at PIMCO, we have an analyst team that works very closely with the PM team. So I'm on the portfolio manager side, but my analysts sit right across the desk from me. And we will be on the same course with issuers. We will be going to the same meetings with issuers, like Christina mentioned. We want to meet the people we own in our portfolio. From the management's body language, sometimes you get different information from what they're disclosing, or it reinforces the information. And it's a key part. So, and also when you're investing with a long time horizon, you are investing in the skill set and ability of people, not just numbers. They can have the best in class balance sheet, but if you don't have faith in the management, you don't want to invest in them. So that's one part of the due diligence process. And also from the ESG perspective, we not only believe in if you want to make a difference, you put money where your mouth is, of course, but you also guide the industry, you guide your investment objects to better comply with, or to create a world that you want to invest in or you want to see. So we have an active engagement component of our investment process with firms, with issuers. So we would provide them with a framework of the list of criteria that we look for in an investment. We want the proceeds to go towards certain causes. For instance, we were championing a Bank of America COVID bond that came to the market a few weeks ago actually, and then, you know, so these are the bigger picture process. And on a smaller, more micro scale, we would be looking at each investment opportunity, assessing it with the view. So what's going to happen to it in the next 2-3 months? What are the risk factors? How is it going to respond to the macro environment? How does it look versus the assets we already own in the portfolio? Are we optimized in our holdings for what we think is going to happen? So the investment process inevitably take a top-down view. So what do we think of the world? And then it looks at, what do we think of this region? What do we think of this sector? Do we want to invest in here? So there is no, the amount of time allocated to each process will be different on a daily basis, but these are the building blocks of my day.
That's fascinating, and I think you've touched on the fact that you don't necessarily just need quantitative skills for this. It's meeting with people, it's making more qualitative judgments. Christina, you've got 20 years of experience in the industry. What do you think makes a great investor, and what sort of skills, when you're looking to hire someone, what sort of skills are you looking for?
So I think especially with fixed income, there's this myth that bond maths and everything to do with bonds is more quantitative, and therefore if you haven't studied a science, if you haven't got a science degree, you would be unsuited to it. I think that's just simply not true. I come from an arts background, and I think that it's actually very important to have a team of mixed skills. So yes, we might have some very quantitative analysts on the team, but actually we also have some who are not that, they're more qualitative, or they might come from a different background entirely and just have learned the quantitative stuff that you need for the job. Because however much I'm sorry to say, however much you think you might learn at university, you still have to learn on the job, and you might think, oh, I was taught this, but actually it's completely different in reality. So everything can, you know, you can train that. I think what you need is a questioning mind. So I think common sense, good judgment, and also maybe a flexible mind. Because one thing I was recently, sometimes it takes courage to change your mind on an investment that you made. It might have not gone that well, or it might have gone too well too quickly. But in either case, it takes courage to change your mind. And I've noticed over the years that I do appreciate working with people who don't have that ego block that, oh, because I mentioned it earlier, I have to stick to my view. And even though it's not necessarily correct, and one can kind of sense it from the person, they feel that they might undermine themselves if they don't stick to their view. So I actually think that's also important. So coming back to it, it's common sense, good judgment, analytical skills, obviously, and it doesn't have to be just qualitative. And then finally, I think the courage and maybe sometimes the humility to change your mind.
I think that's such good advice. And I think something that people potentially don't realize about this industry is that you do make mistakes. It's just part and parcel. And often it attracts the very brightest minds and people with amazing academic records, but it is, you know, a real part of the job to be able to be humble enough to realize that you'll get it wrong. This is quite an unfair question, but could you give an example of maybe sort of a best and a worst in terms of specific investments that you've made and kind of what you learned from them?
That is hard. So I would, I would go with, well, it's not just my decision, because every decision we make at least in my team is very consensus driven. Everybody contributes a different part of the puzzle, and then we decide on something ultimately, and we own the decision as well as the outcome as a team here. So I would take one investment and I would call it the best as well as the worst. So we have substantial holdings of UK financials over the past 5 years. So of course Brexit, that's in the news, everybody knows. So when we were looking at this investment, so first of all, you look at the institutions, UK banks, are they sound? How are they positioned? What's their capital? What's the buffers against all nasty eventualities? You think about it and you go, okay, that is pretty good. I think they're decent. And the next part is, how do you quantify political risk? And that is something investors around the world spend their lifetime trying to work out, because at the end of the day, it's to do with the politicians. So our investment thesis was, we take the risk when we're getting paid a premium. And in deciding how much that premium is, that's always a guessing game, especially when you're a fund the size of PIMCO. So I would call it a best investment because we were able to stay true to our core and our conviction, hold on to the investment and adding to the investment in weakness. Despite challenges internally and externally to the thesis, we were able to stick to it, which I think is extremely important. Like Christina said, sometimes you do make a mistake, you get it wrong, you admit it and you move on. But sometimes it is about having that conviction. So you do your work, you have that conviction, and of course you have to be flexible and honest with yourself, and you have that discussion within the team. So on that front, it's the best trade that we've done. It's worked out beautifully with a lot of volatility. Then comes the worst aspect of it, which is the volatility. So how do you size correctly with that volatility? So it is not just about getting the right trade, it's also about getting the right trade at the right time in the right size. So for instance, when something in cash price terms, let's just make it very simple, you're buying a kilo of apples. So when there aren't enough apples around, it could be £10 per kilo. You like them, so you say, okay, fine, I'll buy some. And you know what, maybe the supply chain is even more disrupted. It goes to £20 per kilo. Do you buy more? Do you not buy them? And how much do you like them when they're trading at £8 per kilo? So do you own more at £8 or do you own less? And this whole debacle and this whole psychological journey is quite taxing, and I think we all learned a lesson from the sizing and the timing of the trade. But ultimately, it is to do with your conviction.
Yeah, that's fascinating. That tenacity is really required. You need to sometimes just hang on and maybe add more. And do you think it helps to be a little bit contrarian sometimes and realize, you know, actually everyone else is thinking differently to me, but that's okay?
I think it's not just us. To start with, my position is, yes, definitely. If you have the conviction, then your best entry point or your best time of investment is when everyone else is the other way. I'm going to quote Warren Buffett. You want to be greedy when everybody else is scared. I think it's him or someone else, but someone smart, way smarter than me. And I do think, and especially taking the size of the fund into consideration, we're probably one of the biggest active asset managers. So we don't have the liquidity we need every day in the market if we want to go with the market. So we fully embrace that fact. We accept it and we embrace it. So we want to get paid for the liquidity premium. We provide the other side of the market on a trade that we want to do, hopefully to get our clients the best execution we can. So someone commented, Warren Buffett said to be greedy when others are fearful. There you go. I was. So yes, I think that's the operating, I would say, the operating principle for me in my investing.
Great. And just a reminder to everyone, please do use the chat function or the Q&A we're very happy to answer your questions. Great. So just slightly switching gears, Sophie, we chatted about this just before the panel. Just interested in how your work-life balance is in this industry, and what do you do when you're not investing?
So I think at the beginning of my career, the work-life balance was a bit tougher because I was doing the CFA at the same time as being promoted at PIMCO from senior associate to what we call account manager. So I think whenever you have to study whilst working in any job, it's very tough. And there comes moments in your career where you probably would have to do that even after undergrad, or if you want to do a master's and MBA or CFA. So at the time doing the CFA was really my objective, and having failed level 2, I was really discouraged because my work was very intense and very stressful. But I went on, and with the CFA exam, you have to wait 1 year to do the exam. So if you fail, you have to wait another year to do the exam. So it kind of does add to the stress because you can only do the exam once a year on a specific date, and the stress is immense. But with time and with it's really important to have a good support network and a routine. And I've learned that your managers and your work team also needs to be very supportive and need to be understanding of your exam and work commitments. I would say my work-life balance now is a lot better ever since I've done the CFA, and because I don't have kids yet, so it's probably much easier for people with the family. And during March and April, it was probably a bit worse because the markets were going crazy. We were speaking to investors and clients all the time, on the phone and on Zoom, but wanted to make sure that they understand like what's going on in the market, especially even in liquid parts of the market. Things were so volatile, and even gilts and treasuries were not trading as they should be. So we did have investors panicking, and the first and foremost was to make sure that our investors are aware of what's going on in the market, and aware of what's going on with their fund investments or their investments with us. And it's to help them. Some of them might need the cash, some of them might want to make the investment, some of them might want to redeem because they need that cash for some sort of reason. So that was very, very tough, I think, for most people as well, given it was COVID and it was a very tough situation. But in the last few months, things have gone back to normal. So quarter end is usually a bit busier for us, but I would say in terms of work-life balance, we finish at a normal time. If it's not too busy during lunchtime, we do get to take a bit of a lunch break sometimes. Sometimes on the Friday would go for lunch with colleagues. And when I'm not working, I would do the usual things. I would meet up with friends for dinner, or I really like exercise classes, so I sign up to all these classes now on Instagram or online because you can't go to them physically. So I'll do them in the evenings, or I would cook. But I think it's a bit of a myth that if you get into a top asset management firm, or if you get into investment banking, you don't have a work-life balance. There will be moments in your career where you are working really long hours if you're trying to do the MBA or CFA or trying to get another job, but it doesn't have to always be like that. Like, I think my work-life balance is great now, and I'm at the point where I absolutely love my job, I absolutely love my team, I love my clients. And yet there are some days where I'm working longer hours, and there's some other days where it's a bit more relaxed and where I can take a bit easier. So it really depends on the role, but I really think you make your own agenda. The more senior you get, the more you're comfortable in your role, and you make your own judgment of when you book your meetings, or when you decide to be busy, and when you decide you need to spend more time with family and yourself because you're not in a good place. And I think it's really important to not think that because you're in the financial industry, then it has to be intense, it has to be stressful, it has to be no weekends. Like, yeah, there are some roles that are like that, but not every role is like that. And you can still have a good career and a good work-life balance and love your job at the same time.
Yeah, I think that's great advice, and I think that's important. The firms vary. If you join firm with a great culture that really values your time as well as the time you spend working, then you can really get that balance. Christina, I'd love to ask you, because I know you have 4 children, and I think, you know, for many of our listeners, it'd be fascinating just to hear how you juggle that, and how you maintain some sort of level of balance in your life today as well.
Yes, well, so I have 4 children. I've been on 4 maternity leaves. I had the first 2 children with one company, and then I had the other 2 children with another company. And in both cases, I took 7 months off and went back to the job. It's I think actually I'm jumping a bit, but the COVID crisis will actually help families be more flexible, because whereas before, even in our firm, working from home was seen a little bit as a cop-out. Oh, what, you're going to take it a bit easy? When everyone was working from home, suddenly they realized actually productivity was almost higher. And I think this will really help working mothers going forward. And it will also help for not even just working mothers, but flexible working. And Sophie was talking about taking the CFA. If you took commuting out of your day, you're already saving sometimes more than 2 hours. So I think that's going to help work-life balance, full stop. When it comes to the children, yes, at times it was really tough. And when markets are stressful, even though I try so hard to not show the stress, the family can feel it, and my children can feel it. They can feel if it's been really, really tough. And so when that happens, you really have to, work on your, exercise, meditation, whatever it is, just to be centered, because it's not good to bring work home with you in that sense. But I think that also that going forward, a lot of mothers don't go the fund management route because they don't want to have an interruption. They're worried about their track record. That the track record is when you start your fund and the clock starts ticking. You're 1 month old, you're 1 year old, you have 1 year performance, 3 year performance, 5 year performance, etc. But I think nowadays the industry is changing to a more team approach anyway. So you could be a fund manager as a woman, be a named fund manager, that's the other thing, but still take time off from maternity leave and still have the continued track record, because that's the other thing, that a lot of mothers who've worked very hard in the industry, once they went on maternity leave, in some isolated cases, they lost that track record, which is just unacceptable. And I think that going forward, the industry will change. So it will all be, I think, yes, it will move in a better direction.
Brilliant, thank you. And yeah, I guess a lot of these misconceptions, we've sort of talked about a lot of them, but Eusta, I'd be really interested in your view on this, why you think the industry potentially has a little bit of a veneer of not being a good career for women, and why potentially more women don't apply, because that's the reason that GAIN exists, is to try and tell people what it's really like and why it's a great job. But what do you think are the reasons that people potentially don't know that?
I think, so I blame Hollywood to a large extent. So I think, well, very naturally, buy-side firms will have, so for instance, like PIMCO, we're extremely low profile. I can't speak for other firms, but we tend to be very low profile, especially on a campus level. So people undergraduates or even master's students tend not to have heard of us until they are already in the industry. And most people's point of contact with the industry are the investment banks. And the opinions are greatly influenced by what is on social media or on film, on TV that they see. However, that is a very limited side of finance, of trading. Like Sophie said, it's not necessarily intense, long hours. I mean, it is intense. It is for people who want to be good at what they do, to want to be the best at what they do. That's how you get to a position of excellence in any industry. That is not new. But what people don't talk about is how much of a human and people element there is to succeeding in finance. So we have said we need to meet issuers, we need to be able to read people, we need to be able to read the managers, we need to be able to establish a relationship with whoever we work with, whoever we invest in, whoever we invest for. And that is where I think women actually have an advantage, be it in how we approach things, how we think about things, or the unfair perception of the society that we have of women. That is to our advantage. And also I think the more collaborative and team approach that women tend to take is also undervalued, but now getting traction. Like Christina said, everything is moving in the direction of a team approach, even in investment. And on sell side, by the time I left, I think we had probably 10 times more female traders than when I started. That's also a good sign. And people now recognize the fact that you don't need to be aggressive. You don't need to be the biggest voice on the trading floor to be heard. You just need to be right, and you need to be consistent. So one of the most impressive portfolio manager I've met is at PIMCO. She is a lady, she's my boss. Her track record is she may not be the biggest earner every year, but she is the most consistent producer. And she runs a very consistent risk profile. And guess what? Clients prefer that. If you were to invest your pension money, you want that. You don't necessarily want a 20% return a year and drop 10% next year. You want a consistent, trustworthy people who you can go to sleep when you know your money is with them. So I think that's being more and more appreciated, but less broadcasted as an industry, and we need to do better at that. And thank you again for giving us the platform.
Sorry, I was on mute. Thanks to you and to our panelists, because this is really what we're trying to shine a spotlight on, role models for young women who can talk about what it's really like and what skills you need. Just to flag, we've got 10 minutes left, and we're going to answer some of your questions now, so keep them coming in, and move a little bit more onto the advice and tips section of tonight's discussion. So Christina, if I may ask you, this is a question that's come in from an art student. And she said, what would the panelists recommend as a first step into investing as a final year art student?
I think, you should really read the Financial Times from cover to cover every day, and just grapple with the different themes and see if that excites you. Is it exciting that gold's gone up or gone down? Does it excite you that different currencies have moved? Does it excite you different geopolitical noise and how that might impact the markets? Because sometimes one thinks one's interested in something, but because you don't have the experience of it, it's still just it's just the imagination. So I think try and see if that excites you. I think that's one thing, and yeah.
Great.
Can I just add to that? When I was preparing for my internship interviews, I did read Financial Times cover to cover. And The Economist cover to cover, and it doesn't make sense. It didn't make much sense for the first couple of weeks, but if you keep at it, you can follow what is happening, and you find that your hypotheses may prove to be correct or wrong. Your instinct may prove to be correct or wrong, and when it comes up in conversation with people, you get a different perspective, and that really helps when you go into an interview. If you were to get one, take it as a conversation.
Yeah, that's great advice, since it gives you a talking piece. Sophie, I might ask you this question, because it's come in two sort of different shades. One, sort of what qualifications and additional skills do you need to be a successful analyst? And someone asking, should you get a master's degree? I know your role isn't explicitly analyst role, but just within your company as well, more broadly, what sort of qualifications do people tend to get? Do you need a master's degree, or is this something that you can do the CFA, which you did, to become an analyst?
Yeah, so I'm probably one of the few ones who don't have a master's or an MBA in my seat, but I do have the CFA. So there's no, you have to have one or the other. I think for interviews for analysts or account manager roles or product strategist roles in our firm, or even in the industry, if you want to stand out in addition to other skills that you may have languages, you may have very impressive academic background, or you may have other hobbies that are really impressive. if you want to increase your chances of getting the role, or if you want to learn something in addition to your undergrad, having an extra qualification does help. So I had the IMC when I interviewed with PIMCO, and I think that, in addition to probably how it was an interview and my CV, did help. But it's not necessarily the case. There's this girl in my team. She's great. She doesn't have an MBA. She doesn't have a master's. She doesn't have a CFA, and she's brilliant. But I do think that if in this world where the CVs that we're seeing are getting incredibly stronger, and the academic requirements seems to be getting more and more intense again to finance, it does help if you have a level 1 CFA, for example. You don't have to interview when you get to all 3 levels, but doing the level 1 CFA shows that you're committed in wanting to be in a front office investment professional job, or it shows that you are really eager to get to learn more about the industry. And obviously it's not easy. And I would recommend starting with the IMC if the CFA is too hard for some people, but there are also other things that could help, like masters in Europe is very common, not so much in UK to get into the industry. And I think the MBA, if someone has a chance to do it, is also incredibly valuable, but it really depends on each individual circumstance. I didn't do the MBA because of costs and because I didn't want to be away for 2 years. If circumstances were different, I would have done it. So it really depends on the individual, but you want to think about how do you stand out on your CV, and then you get the interview, and then the interview is a completely different ballgame. But how do you make yourself stand out on the CV when these firms may be receiving so many different applications? And a qualification can make you stand out, but you could have also other you could have other hobbies or other achievements that make you stand out. So I think it's a plus, but it's not a requirement.
Yeah, I think that's great advice. And actually, we've got a question which is sort of related. I think people feel like they have to be the finished model when they come into the job, and they need to have done all of the learning beforehand, which obviously, Christina, you've mentioned is just not ever going to be the case. Someone has just asked, they're currently interning at an investment management firm, and they're wondering what the best way to go about learning about valuation, how to understand the metrics used, and they're finding some of the more quantitative discussions they're a bit out of their league on. Is there any way that you would particularly recommend that they can brush up on those skills, Christina?
Gosh, on valuation, I don't know. It's fixed income, I guess.
It's investment management firm. I imagine it might be equity valuation.
So I don't know, maybe even just as Sophie was mentioning, the CFA level 1, that's quite a good grounding, and you can go through it systematically, and at the end of it, you've studied it, and then you have something to show for it. I think that's not a bad idea.
And I would say, yeah, particularly in equities, but I imagine, as you've mentioned, it's fixed income as well. It's about lots of qualitative factors, and often it's not a science. There's not a sort of one right valuation. So you kind of learn through experience, what you get a feel for that, as much as the textbooks. Also, a shameless plug for some of our upcoming workshops. So Gain's got a workshop happening each week on a Thursday, and you can see it on our website. We're doing equity case study workshops. So I would really, and it's not just necessarily equities, we've got people with different backgrounds, but looking at valuation as part of that. So, and to that person, if you can sign up, they're booking up pretty quickly. So have a look on our website. Yeah, so we've got a few more questions. I'll just try and slightly off the tips and advice, but there's one about fossil fuels, which I'd like to pose to Sophie, if I may, asking what, if, for example, one of your clients doesn't want to be exposed to fossil fuels, for example, a university, how easy can they switch into non-carbon funds?
This is an interesting one. Actually, we're exploring that for a lot of our various clients at the moment. So if the client can only invest in funds, we do have specific ESG funds where there is low to non-carbon issuers in the funds. So usually most asset managers will have different options and different funds. But there's also clients that have a bit more money that want their dedicated mandates where they don't have any other investors in a vehicle, where they have only themselves. We call them segregated portfolios, segregated mandates, where the client may have very specific concerns, where they, for example, some religious groups may not want to have any pornographic related investments, or you may have some universities, for example, don't want to hold any tobacco or carbon related companies, and they would let us know at the beginning that this is their objective, these are their constraints, and then they could set up their own portfolio where it's just them as the client and entity in that portfolio. And for those kind of portfolios, much easier to tailor to the client needs, because they can, let's say tomorrow they think that a certain country's human rights efforts are just completely against their values, then we can exclude investing in those countries in those portfolios. But if those clients don't want to have their own portfolios because it's operationally quite cumbersome, we do have certain funds that have more low carbon or non-carbon or ESG branded funds, and many other companies also now have that, given that more and more investors are concerned with their ESG and sustainability footprint. And it's great for the industry because historically, as fixed income owners, we haven't been able to impact as much on the sustainability side as equity owners, but now we're actually increasingly seeing fixed income investors really wanting companies such as us to make sustainable investments when we're buying bond issuers and make those bond issuers accountable. So we're seeing a huge shift in the fixed income industry whereby issuers are being made accountable to make sure that their company practice or their model structure, or the way that they are extracting, say, the coal or the mining is going towards the right direction. So as the fixed income investor, it's actually quite incredible to see the shift and the change. And we're only going to expect our clients to be asking for more and not less in the coming future.
If I also may add to that, there are also a lot of third-party providers, because, you know, if I as the fund manager say, oh wow, we're so clean and we have none of this, I mean, hopefully you trust me, but it's much more compelling to have a third-party provider give you kind of like a scan. And there are these so-called kind of fossil fuel scans or carbon footprint scans. And we actually have a service provider who will do that. So they will look at the carbon footprint of my fund, and what's also important there is what's the trajectory. Am I getting better? You know, it's also the journey that's important. And there again, it's good to have a third party objective kind of, you know, grading system that will show me the direction of travel.
Great. I've got a final question, but I love that we've ended on that note of this industry and how, you know, if you want to have a real impact on some of these issues, being an investor is a really tangible way to do that. So just a final question for all of you, and we'll start with Eusta, if that's okay. Just a piece of advice that you would give to your younger self.
Wow. I would make choices based on where it leads you. Does it give you more choices in the future? So put it very simply, whether you want to do a master's or not, it should depend on whether that broadens your choice in the future. Whether you want to come into finance or not, that should depend on whether it broadens your choice in the future. I frankly think, having had a very rigorous start to my career, even if I didn't stay here, I would have brought a lot of the valuable skills, especially the softer skills, dealing with pressure, prioritizing, working with a tight time frame, etc., to whatever career I do. So I think that's a principle for choice.
Great. And Sophie, what would you now say to your younger self?
I wish someone had told me, and and now looking back, I wish someone told me that don't focus on what you can't do, but figure out what is it that you want to do. Don't focus on the 20% that you can't do on the roll, but expand the 80% that you can do, and then try and learn that 20% on the job rather than not go for it and wait 2 years to go for it. Because there are always going to be other men or other people who go for a role when they can only do 50%. go for it. If it's something that you think you can do it and you wanted to do it, just go for it and work really, really hard to get there, and always be learning and inquisitive and appreciate how much you've got, how much you've done, and how much you've learned, rather than just focus on where you want to get, well, what you haven't done or where you want to get to. So I think it's really important to just go for it. There's so many women out there who are worried they can't do that 20%, when seriously, honestly, like if you think you can do 60-70% and it's something you want to do, just go for it and work really hard. And honestly, like then you realize that actually you can do it.
Great. Christina, what would you say?
Yeah, I would totally agree with Sophie. So I think looking back, I didn't sometimes go for that promotion because I was so worried that the new role, I wouldn't be able to do it because I was so focused on my 20%. And I think that, questioning oneself, women can do that too much, questioning too much and want to be the perfect article. No, just go for it. And I think coming back to an earlier point I made is what is your passion? Because when you've been disciplined all your life and you've worked so hard, that comes very naturally to you. But then what becomes more unnatural is what is it what I actually want? When you're so used to being so disciplined and so hardworking, that becomes so innate that then you're kind of almost on automatic. I think if you figure out what you enjoy, then don't worry so much about your first job choice or even the first investment house. Should it have been this bank or that bank or this investment house and that one? Should it be equities or fixed income? Go with what seemed right at the time. And it's not a prison. Every single day you can make another choice. But it's that, take enjoyment in the journey, because, time passes so quickly, and you can then reassess and think, actually, is this aligned with what I'm passionate about? And, I don't know this other 50%. Well, let me go and learn about it because I do love it. So I think if you cannot take, you don't need to climb that mountain in one day. You take it step by step, and just make sure that each time you're taking that step, it is in the right direction at least.
Brilliant. That is wonderful advice to end on. Thank you. So yeah, just a huge thank you to all three of you for being our panelists. We're so lucky at Gain to have such inspiring women, and I think all of you will agree this conversation has been really insightful. I hope it's been helpful for everyone listening in. Thank you for joining. And I would mention this is the second in 5 weeks of panel discussions that we're hosting on Gain. You can find out about the remaining 3 on our website, which is gainuk.org, where you can also find, and in response to some of your questions, lots of resources, so recommendations of what books to read, podcasts you can listen to, free resources. So if you want to have more to talk about in interviews and more learning in lieu of internships, then please do visit our website. We also have an Instagram page, Girls Are Investors, and there we sort of provide some bite-size and interesting updates on what's going on in the Gain calendar, but also busting some of the myths around investing and giving you some information. So please follow us on Instagram. And on that note, just want to say thanks again to the panel. We've loved having you, and you've been incredibly inspiring. So thank you.
Thank you.
Thank you.
Thank
Great.
you very much.
Bye.
Thank you.